Well, good morning, everybody, and thank you for joining us today on our Housing SORP webinar, What FDs Need to Know. So speakers today, as you've probably worked out, I'm Liz Newell. I'm one of the audit partners here at MHA, and I head up nationally our social housing sector. And I'm absolutely delighted that Jack Steer, one of our director RIs in our social housing team, has been able to join me today for our webinar. Just put up our agenda for today. It's a fairly whistle-stop tour of the new Housing SORP. It's quite difficult to fit 124 pages into an hour's webinar, but we'll do our best and we'll focus on some of the key areas. And as I say, do put any questions into the Q&A if you have them, and we'll try and get to those as we go through. It's been a fairly long route to get to a new 2026 Housing SORP. Although the consultation only started back in October last year, it was off the back of the revised FRS 102, which was released a year before that. There was 12 weeks of consultation, and that closed in January, and we finally got the revised SORP released on the 13th of April. Apologies to those of you that had booked on the earlier date in May, but we wanted to have enough time to go through all the detail and focus on the critical points for you, so that we moved it back slightly after the delayed issue of the SORP. That hasn't necessarily given UFDs much time to run through. The SORP is applicable from 1st of January 2026, albeit I'm sure most of you have March year ends, and therefore it will be 1st of April 2026 that it will be applicable to you. But the SORP committee have had quite a lot to consider over those last 8 years since the update. Not only are they aiming to align to the new revised 102 guidance, they're also looking to provide some consistency in reporting across the sector, give you some sector-specific guidance for applying UK GAAP, make sure that there is a transparency of financial reporting, and address topical issues in the sector. So, as I say, we don't have much time to go through quite a large SORP. Let's dive straight in. So I thought I'd start by doing a comparison to the consultation, because there were some bits that changed following feedback that the SORP committee received. There are two areas that were cut altogether after the feedback. One related to grant accounting on stock swaps, and the second one was to some detailed disclosure requirements on employee benefits. I would also note at this point that although not in the consultation, from the old SORP, the financial and joint venture considerations have been removed as well. So that leaves the sections at the bottom there that have been substantially adapted in their format as per the consultation, and we'll go through many of these today. We're going to get the two heavy-hitting sections out of the way first. So I'm going to dive straight in to the revenue recognition under the new framework. So the new FRS 102 adopts a 5-step model, and I'm sure most of you will be familiar with that and have heard how that works since 102 was revised and released 18 months ago. But the SORP committee have specifically considered principal revenue streams of rental income, service charge income, property sales, and grant income within the SORP. There are other income streams that come into registered providers, and if these haven't been considered specifically under the SORP, you should make reference to the new 5-step model under FRS 102. So things such as care home fees need to go back to FRS 102 rather than have a look at the Housing SORP for your guidance there. The long-standing risks and rewards approach that the old SORP considered has been removed, and income should now be considered based on control, whether exchange or non-exchange. Terminology you'll no doubt have heard a lot since the release of the new FRS. Exchange income allows a 5-step recognition model, and while this might not significantly change the timing of income for many housing associations, it does require them to review the income streams more formally with clearer documentation and judgment. I'm just going to focus on the top two, the rental income and service charge income at the moment, to go through where the changes are here. So rental income still remains within lease accounting. The biggest change is on service charge, which must be separated from rental income. It's considered to be a non-lease component and will fall into the new revenue recognition model and reported separately. This might prove a challenge in some instances where there are affordable rents, as service charges are not often separately defined, but they do, under the new SORP, need to still be split out. The SORP refers you to FRS 102 for guidance as to how to do this. And if you do have all-encompassing rent and service charge income streams, you should refer to paragraphs 23.68 through to 23.70 of FRS 102, and that will help you to determine what the split should be. Also, with reference to service charge, there is specific guidance and examples in the SORP if you have sinking funds. So do refer directly to the SORP guidance and the examples there if you have service charge sinking funds that you need to think about. So what are the key actions for your team? The good news is that the new SORP documentation does provide some examples for some of the income streams. We've highlighted, though, some of the key areas for consideration for the income that you will need to think about. So the first is review. Every income stream that's significant to your organisation should be reviewed in line with the new guidance. Does it follow one of the key income stream areas that they've pulled out specific to social housing, or do you need to revert back to FRS 102 to look at that particular income revenue stream and how that should be now recognised? Particularly focus on the high risk areas. Service charges, as I've mentioned, have quite different recognition models now. And there's a number of different agreements behind your transactions, which would have probably been written with the previous SORP in mind, not with the new SORP revenue recognition rules. So they might not easily fit into any of the income stream categories. So do have a look at those. And we're always here for you to reach out to if you need a second eye on those. In the ever-changing world of social housing, we're also seeing more agent arrangements these days. So think about, are you delivering the service yourself? Are you the principal? Or are you just acting on someone's behalf who are delivering the service for you? This will be key to the right income recognition policy. And then the impact. As always, with new regulations, it's the unexpected consequence which sometimes trip us up along the way. So when you have realigned your policies, does that impact your KPIs? What about any loan covenants that you have in place? What reporting requirements and disclosure requirements do you need to consider? You'll need to make sure your accounting policies are updated and your team are given the relevant training. And most importantly, what are the impacts on your wider stakeholders? We'll touch on that a little bit more later on. but there's quite a lot to think about on the income stream side of things, but not quite as much as there is on the lease side. So I'm now going to pass over to Jack to deal with leases under the new SORP.
Thanks, Liz, and good morning, everyone, and thanks for joining us today. So, yeah, I'm going to spend the next period looking at lease accounting under the new framework, and specifically what this means in practice for housing associations and obviously finance teams. So, hopefully by now this isn't a surprise to anyone. It's obviously been talked about for a number of years now, and I suppose for that reason I won't be going through the mechanics of the accounting entries for leases on a granular basis. I think from a technical perspective, the revised approach is obviously heavily aligned to IFRS 16 principles, and therefore there's plenty of resource out there to help you with those calculations. And indeed, we had a recent FD forum, which is available on our website if you do need to sort of see a calculation and working through an example. I think in reality, for most organisations, the real challenge is not necessarily that accounting mechanics, it's understanding contracts, applying judgment consistently, maybe gathering reliable data, and understanding the wider impact across reporting, governance, and operational decision making. So, and importantly, as Liz has mentioned, it's no longer something that's sitting on the horizon. So, for your typical March year ends, the transition date was the 1st of April 26. So that means opening balances from that point now need to reflect the new framework. So the changes are now live, and many organisations are already working through the practical implications. So what I want to focus on today is just a recap on what's changing, where the biggest sector-specific challenges sit, what this means for reporting and governance, and then what organisations should obviously practically be doing now based on that. So just on to the next slide. So what is the change? Well, historically, of course, operating leases largely sat off balance sheet, whereas under the new, under that old model, organisations would typically recognise a rental expense through the income statement on a straight line basis. And I think you'll be familiar that disclosures were relatively straightforward. Of course, on the balance sheet, liabilities were lower. And from a reporting perspective, that impact was, I suppose, fairly contained. That changes significantly under the new framework. So most leases will now come onto the balance sheet through recognition of a right of use asset and then a corresponding lease liability. So instead of simply recognising a rent expense, organisations will now be recognising depreciation on that right of use asset and an interest cost on the lease liability. So what's the practical effect of that? Well, we've got larger balance sheets, higher liabilities, different EBITDA profiles, and then more disclosure requirements as a consequence of that. So I suppose those accounting mechanics are manageable, but it's the wider implications that can be a bit more significant, and that's particularly the case when you start looking at covenant calculations, treasury reporting, board reporting, and how the organisation appears from a financial resilience perspective. So one of the key messages I've been emphasising with clients is the cash impact of the transaction may stay the same, but the accounting story is changing quite significantly. And of course, economically, many of the arrangements haven't changed at all, but from a reporting and governance perspective, the optics of the organisation can look very different. And I think that's where finance teams need to think beyond just that compliance. Okay, so now the technical framework itself applies broadly across all sectors. It's driven by those FRS 102 changes which apply across the board. But for housing associations in particular, they obviously face some very specific complexities that make implementation more challenging in practice. I think in housing, lease accounting is rarely simple. So historic agreements, embedded arrangements, and sector-specific structures mean that implementation will require significant judgment and operational input, really. So, and across the 4 areas shown on the slide, I think the common themes are some added complexity, more judgment, and depending on the organisation's size, perhaps cross-team collaboration. So just picking out those specific areas, we've got the first area, peppercorn or nominal leases. So many housing associations will occupy land or properties under long-standing arrangements, perhaps with local authorities or community organisations, and they can be at very low or nominal rents. And historically, those arrangements might not have attracted much accounting attention because the cash flows involved were small or minimal or immaterial. But under the revised framework, organisations are going to need to reassess that position and check whether a lease exists, whether there is an identified asset, and how that arrangement should be recognised and measured. So even where the operational arrangement feels fairly straightforward, the accounting judgment might not be. And because a lot of those agreements are typically historic, there can also be challenges around documentation quality and consistency. So that's an area to watch out for. The second area, and possibly one of the biggest practical risks, particularly in larger organisations, is embedded leases. So in many cases, the issue is not accounting for the known leases, but it's identifying contracts that contain lease arrangements that were perhaps never previously viewed through that lease accounting lens. So we've seen examples arise in things like IT contracts, vehicle arrangements, energy infrastructure, so things such as solar panels, supported housing arrangements and facilities management contracts. So, and that's where the implementation quickly becomes sort of an organisational challenge rather than just a finance challenge, because of course many of those contracts might sit outside the finance team. They might sit with procurement, operations, property teams or service delivery teams. So there is a possibility there that the organisations discover lease arrangements sitting inside operational contracts that perhaps the finance teams just weren't aware of. So I think strong communication and governance across teams becomes critical. The third area is separating lease and service components. So obviously housing sector contracts will often bundle multiple elements together, rent, maintenance, utilities, support services and facilities management. So under the new framework, organisations may need to separate lease components from non-lease service components for accounting purposes. And again, in practice, the biggest challenge there is not necessarily the calculation itself. It's obtaining sufficiently detailed information from contracts that perhaps were set without this reporting model in mind. So particularly with older agreements, they might not clearly distinguish between lease and service elements, which may require the application of some judgment. And then finally, we've got shared ownership, which introduces another layer of complexity. So these arrangements could combine partial asset sales, retained interest, lease arrangements, and future staircasing rights. So that means that providers may need to apply careful judgment when determining the appropriate accounting treatment and obviously ensure consistency. And obviously because those areas involve significant judgment, they're likely to attract increased audit scrutiny going forward. So that's another area to consider. Just as an off-slide point, we did have an advanced question from an attendee about what threshold should be applied for low value items which are exempt from recognition as right of use leases. I suppose the answer is that neither FRS 102 or the new SORP prescribes a specific monetary threshold. but instead the assessment is based on the nature and value of the underlying asset itself, rather than applying a fixed pound amount. So I think in practice, assets like mobile phones, laptops, your photocopiers, any small office equipment would typically be considered low value. But the SORP is very clear that higher value assets, and in particular things such as vehicles, would not qualify for any exemption and should be brought onto the balance sheet. So, as with many areas of the new lease accounting requirements, I think organisations will just need to apply some judgment, ensure their policy is consistently applied, and of course do speak to your advisors, auditors, to sort of agree on the approach going forwards. Now, one of the most important points for boards and finance leaders is that this isn't just an accounting change. It can materially affect how the organisation looks from a financial reporting and governance perspective. And the potential impacts are things like gearing ratios, EBITDA, interest cover, covenant headroom, and treasury reporting. So this is where organisations need to think proactively. And we're expecting that we'll see sort of materially higher liabilities, a shift in those key metrics, and ultimately changes to how performance indicators appear to both boards and lenders. So I think early engagement becomes critical. Boards and audit committees in particular need educating on that quite early. It's a departure from following the cash flow of a transaction, and sometimes that can be quite difficult, particularly for non-finance board members, of course, to understand. And then where there are covenant calculations that might be impacted, obviously lenders shouldn't be hearing about this for the first time at the year end, so clearly you would hope that they're aware of the changes, if not the impact of them. But I think one of the biggest risks is allowing the accounting outcome to be a surprise to these stakeholders. So I think the organisations managing the process best are the ones having those conversations very early, and perhaps presenting what the position will look like early as well. Okay, so in practice, implementation challenges tend to fall in three broad areas. So we've got data, systems, and judgment. Starting with data, many organisations simply do not have a complete and centralised lease inventory. So contracts might sit across multiple departments, renewal terms might be unclear, there might be historic agreements which are not well documented, and potentially those embedded lease arrangements that we've previously mentioned. So for many finance teams, the biggest challenge is just establishing the confidence that they've got the full lease population. Second, in terms of systems, I think a lot of organisations are initially managing calculations through spreadsheets, and in the short term that might be workable, but as portfolios grow, reassessments become more frequent, and disclosures more detailed, then spreadsheets can quickly become difficult to maintain and control. So some organisations are now assessing whether some dedicated lease accounting solutions are required, and then obviously how those systems integrate with existing reporting processes and fixed asset registers, etc. So that's something else to consider. And then finally, judgments. So areas such as discount rates, lease terms, extension options, and the low value exemptions that we've mentioned, they all require consistent and well documented judgment. And because those assumptions directly affect reported liabilities and performance metrics, again, they're likely to receive significant audit scrutiny. So governance and documentation becomes just as important as the calculations themselves. And as I say, I'm certainly encouraging that early engagement with auditors this year to make sure that everyone's on the same page for implementation. So what should organisations be doing now, and what does good preparation actually look like? So The organisations navigating the transition most effectively are generally doing things early, and indeed many are already adopting the adjustments in their management information effective April 26. So it's building that complete lease inventory, actively identifying any embedded leases, and then assessing the covenant implications early and engaging with lenders proactively. It also involves making decisions around systems, accounting policies, governance frameworks well before that first applicable financial year end, and then importantly, educating the boards and audit committees early so there are no surprises when those financial statements are presented. So, as I say, typically a lot of associations are now in the middle of their 2026 audits, so it's a really good opportunity to maybe run through some of those figures now and get your auditors involved and particularly around any subjective areas ready for next year. I suppose the key message is don't underestimate that implementation effort, and that the technical accounting is only one part of the challenge. So in summary, the accounting framework might be standardised, but the housing sector challenges are highly specific, and organisations need to engage early, involve the right teams, and address the governance impacts proactively, and they'll be in a much better place for a smooth transition. So I'll now hand back to Liz to pick up grant accounting.
Lovely. Thank you very much, Jack. Well, after those two fairly hefty first sections, I'm sure you'll all be pleased to hear that grant accounting is a little bit of light relief under the new SORP. As I mentioned earlier, there's been limited changes in the final version. The feedback on the consultation pushed back on the changes that were expected. So there isn't so much action to be taken here as we thought there might be, but it's a great opportunity for you to review your existing grant arrangements and make sure that the treatment is still correct under the new SORP. Have a look at your current policies, have a look at those current agreements and arrangements, and just look at the SORP requirements under the grant section. They've still managed a good 5 pages in there on the grant accounting. And just as a reminder and a recap, when should you be recognising your grants? Well, there are 2 key boxes to tick around the recognition. One is that you're actually likely to receive the grant, and you've got reasonable assurance there. And the second is that as the registered provider, you will be able to comply with the relevant conditions attached to that grant. And just as a final reminder on grant accounting, when it's used to deliver social housing projects, just make sure that you're matching the grant to the lives of the assets that you're delivering there, and one should unwind with the other in the financial statements. I say a very quick and light touch on that for me. And now back over to Jack for the hot topics.
Mentions. I'm now going to move on to the wider hot topics emerging from the final SORP. So alongside the headline FRS 102 changes, the final SORP also reflects a number of broader pressures currently facing the housing sector. So what's interesting is that many of these are no longer purely operational or regulatory issues. They're now feeding directly into the accounting disclosure and governance expectations. So there's 4 themes we're seeing come through most strongly, which are building safety and compliance, sustainability and decarbonisation, greater consistency across the sector, and increased focus on governance and transparency. And in many ways, the accounting complexity is really a reflection of the wider strategic pressures that organisations are now managing. So the first area is building safety and sustainability. So as I say, one of the clearest themes emerging from the final SORP is the increasing focus on capitalisation judgment, particularly around building safety and sustainability expenditure. So, as you'll be familiar with, housing associations are now making substantial investments in existing stock to meet updated regulatory requirements and obviously improve building safety and support wider decarbonisation and retrofit objectives. And that's created a bit of diversity in practice across the sector around what gets capitalised versus expensed. So in response, the SORP includes a bit clearer guidance around the application of FRS 102 principles, particularly in relation to replacement components and future economic benefit. A key point is that expenditure should only be capitalised where it provides incremental future economic benefit. And importantly, the final SORP now explicitly acknowledges that this may include enhanced environmental outcomes linked to those decarbonisation objectives. So, for example, where retrofit works improve energy efficiency or extend the useful life or performance of an asset, there's perhaps a stronger argument for capitalisation. At the same time, the SORP also clarifies that certain costs should generally rather be expensed than capitalised, things such as temporary accommodation costs, where those costs are not considered necessary to bring the asset itself into its intended operating condition. Another important area is derecognition. So where components are being replaced, particularly through retrofit or remediation programs, organisations need to ensure that the carrying value of the old components is appropriately removed. So I think broadly the direction of travel there is towards greater consistency, clearer judgment and justification for capitalisation decisions and stronger documentation of judgment, really. Another major theme running through the final SORP is the clear attempt to reduce that diversity in practice across the sector. I think it's important to stress that in many of these areas, the SORP is not necessarily introducing completely new accounting principles. What it's doing is reinforcing existing FRS 102 requirements and providing much clearer sector-specific guidance in areas where accounting treatment had perhaps become inconsistent between providers. So in other words, the issue wasn't necessarily that organisations were getting the accounting wrong. The issue was that economically similar transactions were sometimes producing different accounting outcomes across the sector. So the areas that have been specifically targeted include service charges, shared ownership, component accounting, regeneration schemes and lease accounting. So for example, on component accounting and retrofit activity, the revised SORP places much greater emphasis on the need to de-recognise replaced components, as I've mentioned. Historically, some organisations capitalised replacement expenditure, such as windows, roofs, heating systems, but without always removing the carrying value of the original component. And the revised guidance now just reinforces those de-recognition principles much more clearly. As mentioned on the last slide on decarbonisation expenditure, the SORP now explicitly acknowledges that enhanced environmental outcomes that are aligned with social purpose objectives may contribute towards future economic benefit assessments. So that's important because providers are increasingly investing in retrofit programs and where the property may have already been operational, but expenditure improves sustainability performance and long-term asset quality. There's more guidance there. We're also seeing additional clarification around service charge presentation, shared ownership treatment, and regeneration accounting, particularly in those areas involving significant judgment around classification, presentation and timing. So you can see that the overall direction of travel is clearly towards greater consistency, greater comparability, and much stronger documentation to support accounting judgment. So obviously organisations will need to demonstrate not only that on an accounting treatment that's technically supportable, but also that it's being applied consistently and governed appropriately. So stepping back from the technical detail, I think the biggest takeaway from the final SORP is that finance teams are dealing with a lot more judgment and therefore a lot more scrutiny than ever before. And in many areas, there isn't always going to be one completely clear-cut answer, whether it's around capitalisation, component replacement, regeneration, or lease arrangements. So organisations are increasingly going to have to make judgment calls in those areas where practice might have historically differed across the sector. So it's certainly a shift towards consistency, documentation, and avoiding surprises sort of late in the process. So I think we realise that most finance teams are kind of already stretched. So the organisations that manage best will probably be the ones that identify those difficult areas early, agree their approach up front and document those decisions, and again do seek the support of your advisors in that process as well. So yeah, hopefully that's useful, and I'll hand back to Liz for the next section.
Lovely, thank you, Jack. And over now to presentation and disclosure. It goes really without saying that when there are new accounting standards, that always comes with an increased requirement to disclose the impacts to your readers and stakeholders. Aside from that, there's been also one notable change to expand the narrative reporting that is required within your financial statements, and that being from those providers who have over 5,000 homes under management, now to require narrative reporting for those with over 1,000 homes under management. On the face of it, that sounds like quite a big jump, but during my research, it's around just 85 registered providers that will come into scope that weren't previously in scope for the narrative reporting. So hopefully it's not too onerous a task for those registered providers to bring their narrative reporting up to date. And as with all of these things, it's very specifically stated in the SORP that the reporting should be commensurate with the size of the organisation. So even if you have just trickled in scope, just over 1,000 homes under management, it doesn't need to be a significant task to get you up to speed on the new requirements. But as I mentioned, and as Jack has alluded to throughout this presentation, all of these new requirements need explaining. We've touched a number of times on how this will impact the readers of the accounts and the stakeholders. And there are some key areas that will need narrative explanations in your financial statements where you've made policy changes. So I've pulled out some of the key changes: lease disclosures, revenue recognition. There will have been some significant judgments and estimates made for this coming set of financial statements compared to those prepared under the 2018 SORP. And there really is a greater impact on transparency and explanation. As our finance world gets ever more complicated in social housing, we need to make sure that we think about how that's presented in an understandable way to the stakeholders and readers who, if we think the terminology and changes are complex, well, goodness knows what they think about it. So finding ways to explain in plain English what changes have occurred, and why, more importantly, why they have occurred, what the impact is on the organisation and the various stakeholders is going to be absolutely key as you move forward. So for those of you that might be watching the webinar who have fallen into the new narrative reporting, or for those that perhaps just need a reminder as to what needs to be included, I've put a little bit of on screen for the annual report. You'll notice it's no longer strategic report. They've actually changed the name so it doesn't confuse with Companies Act 2006, as there aren't many registered providers that are actually regulated under that Companies Act. So they've changed it to annual report. On the left-hand side there, you'll see many of the areas that are required for inclusion. And these will all take some consideration over the next year. Your business model may well change as some of your financial transactions are reported differently, and therefore your objectives for achieving the model will also need to change. How are you going to do it? How are you going to get there? What's your strategy to get there? You need to make sure that your development and performances throughout the year, at the end of the year, and into the future are in your annual report and detailed out in a way that anyone could understand as they read through your annual report. What are your main risks and uncertainties being faced? And almost more importantly, what are you doing to de-risk your organisation? How are you going to face the uncertainties, some of those unexpected consequences we've been talking about as we've gone through today's session? You will, as always, be expected to have financial and non-financial KPIs within your narrative reporting, and this often feeds into value for money statements within the registered providers. And of course, you still need to have your governance and regulatory statements included within the report as well. Most importantly is the style and objective of your narrative reporting. You need to make sure that the report is fair, balanced, and understandable. It should be concise. It doesn't need to be War and Peace. We've all read those annual reports that are really too long, and actually the same could be said in a much simpler and more concise format. One of the key things here to think about is almost a golden thread that runs through your financial statements. So your annual report shouldn't stand alone. It should link in with other areas of your policies, your disclosure notes, and of course, your main financial statements. What's the story you're looking to tell? And how do the rest of the document fit in with that story? And finally, again, perhaps goes without saying, but it should be reviewed annually to ensure it still meets all of the objectives and requirements. We've all seen those reports that look very similar year on year with just a couple of paragraphs changing. And everyone, as Jack said, is stretched within their finance teams and within the trustees, who ultimately are generally volunteers. So maybe now's the year to do that fresh look in line with the new guidance, in line with the new narrative reporting, and make sure that your readers fully understand what you've done under these new SORP guidelines. I'm going to hand back to Jack now for some final advice on how to prepare your teams.
Thanks, Liz. So yeah, I'll finish with a few thoughts around preparing finance teams for the changes. And as we've said, I think the reality is that most finance teams already have a huge amount on their plate with year-end pressures, audit requirements, regulatory reporting, staffing challenges, and now significant SORP changes. So there probably aren't many teams sitting there thinking they'd like more accounting judgment to deal with, but that really is the direction of travel. And across all the areas we've discussed today, finance teams are increasingly being asked to make judgment calls in areas where there isn't always completely a black and white answer. So, and at the same time, there's greater scrutiny around consistency, documentation, and how those decisions are evidenced. So for many organisations, the challenge isn't necessarily understanding the rules themselves, it's finding the time to and resource to apply them consistently, document decisions properly, and avoid issues only emerging late in the reporting cycle. So next slide. Just to finish, I think the key focus for finance teams now really comes back to the major SORP changes we've discussed today, so particularly around the income recognition and lease accounting. And the priority now is making sure that the higher risk or higher judgment areas have been properly identified and assessed early enough, well before the year end. So on lease accounting, that might mean reviewing complex arrangements, identifying embedded leases, or reassessing historic treatments. And on the income side, it might involve looking again at contract terms, performance obligations, and consistency of treatment across schemes and transactions. Alongside the technical accounting itself, there's now a much greater focus on judgment, consistency, and documentation, and increasingly auditors will want to understand why a decision was reached, whether similar transactions are being treated consistently, and whether that rationale is clearly supported. Because ultimately the technical rules themselves are becoming clearer across the sector. The real challenge is now applying them consistently and avoiding surprises late in the reporting process. The final point there to mention is obviously having completed today's webinar. If you're really desperate to early adopt the new SORP, you can do that. But you do need to adopt everything within the new SORP, so you can't pick and choose certain elements. It's an all or nothing approach. So yeah, if I pass back to you, Liz, to pick up any final thoughts.
Lovely. Thank you very much, Jack. And it really just leaves me to say there are, I don't think, any questions in the Q&A. So either we've done a marvellous job, Jack, of explaining everything, or we've completely baffled. But you can see on screen there our contact details. Please do reach out to us if you do have any further questions on the new SORP. We will be sending round a link to the slides and the webinar so that you can revisit the bits that are particularly relevant to you. And I wouldn't be doing my other colleagues in our sector justice if I didn't mention that we also have a very sector-specific tax, VAT and internal audit team as well. So if there are questions that have arisen out of this that might impact on any of those areas that you think you need some assistance with, please do just reach out to myself, Jack, and we can steer you in the direction of others in our social housing team. But thank you very much for your time and for attending this morning, and we wish you a very good rest of the day. Thank you.